Well, good afternoon, investors. Welcome to our April 23rd, 2024 edition of Bull Sessions. My name is Mark Robertson. I'm founder and managing partner of Manifest Investing, and I'm joined here by my dear friend, the magical, magnificent mathematician from mid-Michigan, Ken Kavula.
You just keep finding adjectives, don't you, Mark?
I, I'm, I,
Okay.
might, I might have to find a few more.
I
And
want to I want to take just a moment, Mark. I've been pleasantly overwhelmed with correspondence from our face-to-face meeting last Saturday.
yep,
And I want to thank everybody for all the kind words that were offered. And I am working through those emails one at a time. I've had an awful lot of stuff going on in my personal life here the last couple of days, but none of it negative, but just real busy. And again, thank you for all the kind words. Thank you for the great questions. And please just be patient. I'm working away at those emails, and I'll get a response back to you in the next couple of days, I promise.
yeah, I have sent out a record number of PDFs of the slide deck used. So we clearly struck some nerves again. We need to hold more sessions in that room. Apparently, we had a
Well,
pleasant
not
experience there
only
with
in that room, but we need to do more face-to-face meetings if we possibly can. The interactions between people in that audience and yourself and myself they were heartening. They were full of actual content, and I think they were very educational as well as being entertaining. So let's hope we can get some of this face-to-face stuff reinvigorated and end up with some audiences of a decent size that we don't feel that we've wasted our time in driving to get to a face-to-face event. You know, I love meeting 40 or 50 or 60 people face-to-face for a morning or a full day event. And if you'd like us to try to drive to where you are, we're not going to drive 7 or 8 hours anymore through the flatlands of the Midwest, but we still have the possibility of driving to places like almost anywhere in Ohio or Indiana or lots of Illinois, of course the rest of Michigan, and we'd love to come to your event if you'll have us.
yeah, good clean fun. They say that a radius around Columbus, Ohio, you get like 50% of the population with only a 200-mile radius or something like that. So
Yeah,
maybe it's a little more than that.
there's a lot of good manifest members and BI members in those geographies. So
All right,
let us know if we can help.
we would love to. And Matt Spielman is actually he got a note from the investor relations person at some radar company, LiDAR, whatever. He's actually at Radar Fest of some sort for the automotive industry today. So he's out, but we do have Steve Emmerich in the back room pitching in also. So thank you, Steve. All right, so let's go ahead and get underway. I am going to, we'll come back to some of this, but some of the baby bulls and stuff. I still wish I had that red laptop on the right, Ken. I really, really like that laptop.
I know that was one of your favorites. I know that, Mark.
All right, here's our weekly tribute to Portillo's. It was featured in a fairly favorable article in uh, Zach's research. So some people are noticing. They need to notice more. Um, I am a shareholder in Portillo's, and I recently added a few more shares to bring my cost basis down, my average cost basis. But this is our weekly reminder that Portillo's is not a sponsor of this session, but they should be. All right, here's the official paperwork. No investment recommendation is intended. Those are the important words. Even more important, however, is the fact that this is about education, demonstration, and illustration of a bunch of methods, techniques, and philosophies of the modern investment club movement. We're literally talking about the discovery of stock ideas to study, the analysis of those ideas, and the implementation of them in a portfolio that is designed to succeed. So the portfolio design and maintenance is part of all this also. So we'll be sharing our opinions on those time-honored methodologies. And you are reminded to please do your own review and analysis of any company before calling your broker. Remember the days when you had to call your broker, Ken?
Yes, I do, and shell out a significant amount of money to that broker as well.
That's right. Well, we don't do that anymore, but again, make your own decisions. If we own something, we'll try to disclose. Remember to disclose it, and please make your own decisions about anything that you find to be helpful in the realm of investing. Our two email addresses are down at the bottom if you have any ideas or things you want to kick around. And other than that, let's talk about roundtable registration. Ken likes this because it's working.
It's absolutely working. If you'd like to be added to the Mid-Michigan guest list and get a monthly email that tells you when our next roundtable program is going to be and provides you with a link in order to register for that month, then follow the directions that you're looking at right now. That URL in blue will take you to the Mid-Michigan page on the Better Investing website. That particular URL takes you to something on the public side, so it's not necessary to even be a member to hit this particular link and to get somewhere. Once you get there, follow the directions in red especially. Scroll all the way down the page, almost to the bottom. You will not see this form until you scroll down. So scroll down till you see the form, fill the form in. It's four real simple things to fill in. Hit subscribe, and that's it. You'll be added to our guest list, and you'll be receiving our once a month email reminders about the Mid-Michigan programs. We'd love to have you join about 1,500 other people from around the country that we're communicating with, and we're providing what we think are pretty high-class programs to them on a monthly basis. So if you're not on the list already, put yourself on the list. We'd appreciate it.
Yeah, come and check it out. In fact, this weekend, Ken pointed out and basically confirmed that I come up with two or three of the best investing presentations and stock studies in the history of investing every year. So, you've got a pretty good chance if you come to a roundtable of catching one of those.
If you listen to Mark every 2 or 3 months, he comes up with 2 or 3 of the best presentations ever made. So
They do have different results from time to time. I haven't figured
I
out how to
know,
measure that
I
yet.
know. Occasionally it ends up at the top of the list as well.
Hey,
I'm not going to make any snarky comment other than that, Mark. Okay, we're ready to go here.
stock prices fluctuate. All right, here's our weekly chart. I did add a little bit of color to it this week just to make a point. Again, you're looking at the bar charts represent the total stock market as measured by the value line arithmetic average. And they zig and they zag. The blue line is a trend line, a regression or a trend line through those points, basically charting at about an 11% growth rate over the years. The orangish or yellow or gold line is the value line median appreciation projection. That's a mouthful, but it's basically the average if you took all of the companies in the value line survey and came up with an average forecast, and that's clicking around at about 10%. My par is the median projected annual return of all the companies in our coverage universe, about 2,700 stocks. And that same technique, what is the average forecast roughly? And again, those are all checking in at about 10%. The red, yellow, and blue is just simply to make the point. You can see the math there. The only thing different in all three of those boxes is the number of years. Value Line does a 3 to 5 year forecast. So what that is basically telling you is that it's not 10%, it's 10% plus or minus. Anytime that you see a forecast, you should regard it in that same type of framework or thinking. And in this case, that 50% converts to call it an 8 to 14% return forecast. How's that, Ken? Does that shed some light on
I think
something that
that
people are curious about?
if people are listening, I think it becomes more and more clear what this chart is showing us, and basically we could reduce it to that single sentence: stock prices fluctuate. They have a general average that we can kind of follow around 10% over long periods of time, but stock prices fluctuate. Get used to it.
And we like it when they fluctuate up.
Sure do.
All right, here's a quick look at our Groundhog Challenge. It was a turbulent week. We have a new leader, one of those alchemists from New York, Rochelle Bauman. By the way, you wanted her to be displayed last week, Ken, and we displayed her family member, Brett, because he had moved so far up the list. But this is Rochelle's week, and
Well, and I see that Brett has moved up 11 places. Besides Rochelle moving to the top,
he
Brett
is
is up to 22nd place right now. That's pretty decent as well.
he's continuing to soar, and Alchemy has joined the party also. That's their club at number 27.
Well, I've fallen off the list down into, what'd you say, Mark, about 60th place right now?
Something like that.
And something like that. But my family club has moved up into 31st place. So I can breathe easy. I still have one entry in the top 40, so I'm all set.
Well, our newcomers from Illinois, championed by Steve, are still hanging in there at 34th. So Prairie Investment Partnership. But there's several new names on here, and there's also some I would consider them clear and present dangers. Those ones with the asterisks, Curtis and Anna, prior champions that are moving up the list. So
That's the Gombars, right?
yeah, the Gombars.
From Holly, Michigan, I think.
That is correct.
And there's the broad assets making their charge up to the top of the list up there from this last week from 18th to 3rd. Mark, are the Yorkshire Ladies, that's a brand new club to the contest, isn't it? Or is it just maybe that they're brand new to the top of the contest? I'm not sure.
Yeah, they've been in a couple of years. They're relatively new, but they are a subset of that St. Louis community of volunteers also.
Okay.
Good stuff. So not too many other major changes. We did notice that the average groundhog total return has slipped back below zero, but it's back above it today. Today's a pretty good day. Um, I'm actually down with Kathy Wood. So that gives you some clue as to where I'm at. This
Oh dear.
ugly number that you see right there.
Are you below the monkey mark?
Oh, so cruel. So cruel.
I
Yeah.
know. I know.
But Kathy's here, and I am below. I'm significantly below the monkey. So we'll just move
Oh
on.
dear.
All right.
I shouldn't say too much because I'm approaching the monkey. So
This stuff has a way of humbling us. All right. So this is a newsletter excerpt that came from the Bryans, Brian Feraldi and Stossel, and I don't remember the other Brian's name, but um, they were responding to this text or tweet or whatever it was about Brian Stossel basically Stoffel actually publishes the returns on his portfolio, and they've been good, but they're basically equivalent to the QQQs over the last few years. And again, the Nasdaq 100. We'll take a look at the companies that are in there, and it is a formidable investment. But he asks just basically this good question: why don't you just get out there like Forrest Gump and run and let your portfolio be put on autopilot? And it is a question that merits um, some attention. So let's go ahead and talk about it a little bit. Here's that list of the top 20 performing funds by the amount that they're beating the stock market. That's the column on the far right. The relative return, that's the answer to the question, how much are you beating the market by? Notice how few of them are above 5%. Notice that the Invesco QQQ, which is the NASDAQ 100, checks in at number 7 with a 17.3% return over these last several years. So Brian's returns over that same time frame are basically comparable. And so it's a fair question. Kick it around a little bit. It's been a pretty good run for the Invesco QQQs, and they were heavily advertised during sporting events, including the recent basketball tournament. So one of the things that we do like to point out, we will always point out that these are the most successful funds out there that are equity based, and their average checks in at 13%. That is a number that we strive for in our portfolios also. Anything that you want to add here, Ken?
well, maybe QQQ should be added to that list of that we make that show the magnificent Manifest 7 and all the other ones that we put. Maybe we should add QQQ just as a reference point, because it's fair for us to show what the big indexes do, and maybe it's fair for us to show what a widely owned ETF does as well.
All right, and you weren't. This wasn't in the deck I sent you earlier, but here it is.
Oh my
And
goodness. Okay. All right.
interesting difference here. If you go all the way back to the turn of the century, it was only a few months old at that point. Um, very different results. And you want to be careful out there with what you're investing in. This happened to be after a 4-year very solid run for the companies that composed the NASDAQ 100 at the time. So they were red hot for a 4-year period. But if you go back, the frame of reference here is important. If you go back 25 years, you're talking about this number. Now,
And that value, that date, is much more in line with a lot of the dates that we're using in that 7 stocks, isn't it?
it is. It definitely is. And you can see those are all doing pretty well relative to that. Many of those companies would be part of that NASDAQ 100 results. So again, the context is, watch your time frames. This particular collection of companies, this is the actual companies that you invest in if you buy the QQQs. And by the way, I bought QQQ for an IRA last week. So I do invest in this particular exchange traded fund. And this is what I bought. 9% Microsoft, 8% Apple, 6% Nvidia, and all the way down the list, I don't think there's any surprises on there. We know all of these companies.
Mark, help refresh my memory. LIN, what is that?
I knew you were going to ask that. Somebody in the audience has to know.
Okay.
I'll know it when somebody tells me what it is.
I'm pretty familiar with everything else. Lindy, says Sandy Castor, and Sandy, thank you for the answer. And that doesn't make it any clearer. I don't recognize that
Well,
company at all.
that's
So
like
we'll
the
have to take
air
a look at
products
it.
company, right?
We'll have to take a look at it. Yeah.
Okay.
Oh, she says, is that the new name for Praxair? That's what she's saying now. She wrote
Oh,
Praxair next.
okay. That
Okay.
makes sense.
Yes, it's just a new name for a company that we do know. Okay. Praxair is very familiar to me. Yeah.
So the other way to think about this, again, this is a number of technology type companies. There's a couple different ones in there, but I know Pepsi's in here. Um, you're basically buying this collective of companies with a 12% growth rate, an A plus financial strength, pretty up straight and parallel when it comes to their earnings, excellent quality, extremely excellent quality, and then the two return forecasts again are in that 8 to 10% range that compare pretty favorably. So that's the investment that you're buying. You're basically buying into all of these. So
And I think we could legitimately say that all of these would be considered large cap companies, and by some of the definitions coming that we use to qualify size, a fair number of them can actually be called large companies also. That sales growth, maybe below 8%. So we have uh, Mark, maybe this is what we put into the Buttonwood portfolio,
we
although we are trying to deal with individual stocks, but maybe this is our anchor stock in the Buttonwood portfolio.
maybe we have that debate. Absolutely. So here's what you'd be
Yeah.
buying. Again, keep in mind that I will never forget Ralph Acampora standing on the stage at around the turn of the century, telling our audience, who are basically an audience of stock pickers in general, that anybody who invested in the S&P 500 index fund back in that time frame was going to get killed, and that's a direct quote. And most of the audience gasped and expressed concern about their friends and family members who were doing nothing but index investing. And lo and behold, the lost decade showed up to to make Ralph right. So you always want to be aware of what is the collective expectation for those type of investments. All right. All right, I was just about ready to let this topic go, Ken, and then Brian hits me with this one in my email, And I know it's a topic that makes many of us uncomfortable. I may put together a series of slides using that factfulness book about things that we believe that aren't necessarily as true as you think they are. Um, I have attempted to make my case that we really de-emphasize the use of the current PE ratio in the stuff that we do. I didn't say ignore. I say properly put it into the context it deserves. It's one piece of the puzzle. And Brian actually came up with this list of things he cares about more than the current PE ratio. And I share most of these um, perceptions. So
Well,
you're going to yell at
Mark,
me, Ken?
I certainly think, Mark, that if during the last 3 years, if we didn't learn that day-to-day PEs can be extremely misleading, especially when you're going through market turbulence, if we didn't learn that lesson, then I don't know if we deserve to be investing in individual stocks. The current PE is not the long-term average. It's not something that maybe has some significance attached to it. The current PE can just jump all around all over the place, and sometimes for nothing to do with the safety or the well-being of the company. So I agree with Brian. There's a lot of things that you should be looking at, not ignoring the current PE, but looking at and saying to yourself, this might be just as important. This might be telling me information that can help me make my decision just as easily as whether or not the current PE is significantly different from the long-term average.
Yeah, and this list of stuff is all pretty important when you think about it. Could be the executives in the corner office, the CEO tenure, this notion of brand, respect, quality, um, obviously the trends with respect to cash flow or profitability, for that matter, growth, revenues, and I'm not sure I know what net promoter score is, so I may want to go back and look at that. But uh, Ken, you did an entire series on disruptive companies and technologies a few
Yep.
years
And
ago.
and Mark, I think this last one, this moat direction, that's exactly where we're headed in a couple of slides when we start talking about this very large industry with a lot of big players in it that we're going to be putting up there and kind of asking some questions about. So there's just so many important things on here that you can't reduce it to the PE is too high and therefore I'm going to ignore the company. You just can't reduce it to a sentence like that.
No, it's a snapshot and it's a one piece of information. So that leads into this one. I've just thought I would recycle some slides and bring this one back. We are going to add this to the company report pages here very soon. Kurt's working on it right now. And this notion of projected return on value and the fact that it is, and again, I'm not saying this is the end all, but it is an additional metric that can be very informative and it can be very significantly influenced by a number of the factors on that previous page. So again, we borrowed this idea and modified it a little bit on the work of Joel Greenblatt, a very successful investor and professor at Columbia University. And it's just something that you want to cozy up to, and might take a little bit of homework and some effort, but figure this one out because it will serve you well. Your thought, Ken?
Well, Mark, when we first started talking about proof, I had my doubts about whether we needed another metric. But when we started to move into it just a little bit and started to find out that this was a metric that was being used by some of the most respected people on the street, and it was being talked about by some of the journals that we truly believe are reflecting the best thinking in stock analysis. It just could not be ignored, and I think that you need to read this slide very carefully, and then you need to understand that it's a very easily derived metric. If we end up with this as one of the metrics on the dashboard, I think it makes it even easier for people to actually begin to use it then. So I'm all in favor of anything we can do to pr project the concept and then to use the concept where it's appropriate.
Yeah, so here is a look at, I guess, just from a visualization, what are we talking about? We're talking about a level of profitability. And the specific level of profitability is the projected operating income. It's pretty close to cash flow. And I'm putting quotes around what I just said, but pretty close to cash flow, but the projected 5-year operating income. And basically comparing that or dividing it by the enterprise value, which is the value of the company as measured by the stock price, plus their total liabilities, all debt liabilities and all current liabilities, and then also accounting for the cash that happens to be on their balance sheet or in their wallet. And again, we like to point out that the original stock selection guide, that is from 1951, the original stock selection guide actually displayed sales and pre-tax profits. It didn't display earnings. It didn't even calculate earnings per share growth. So just going back to where we came from a little bit. So again, the talking points, it focuses on the business model. Basically think preferred procedure, and we're building an analysis of the sales and profitability trends, much like Brian mentioned in that slide, the previous slide. One of the things by looking at it in this way, you stay away from the tax adjustments and disruptions that come with earnings, because earnings is basically the compliance with tax laws and regulations. It includes the influence of comprehensive debt capital. Greenblatt actually uses long-term debt. We found that that was a lot noisier than just saying, okay, just add up all the debts, then look at total liabilities. And that's why we say it's comprehensive. So any change in that makes a fairly important change. We find that the results, the projected return on value compares to the projected annual return in section 5 of a stock selection guide. So you're looking
Mark,
at
this
the,
is,
go ahead,
I'm
Ken.
sorry, finish your thought, Mark. Finish your thought.
Well, I'm just saying, I think the results are more stable, and it also enables analysis, and this is key to one of the reasons that we like to look at it. If you think back to Amazon or Tesla 10 years ago, very, very difficult, if even possible, to do a stock selection guide on those companies back in that time frame. We did a whole session on this about 2 years ago, where you could actually come to a conclusion about the investing potential in companies like that. And last but not least, you do it without using PE ratios. So we think that's kind of compelling, and we'll show you how Ken uses it here in a second.
I'm
Your thoughts?
I'm just thinking, Mark, that this 1950s SSG, the precursor to what we use today, is just emphasizing why the preferred procedure was exactly that. It was preferred because once you had this data on this particular chart, then you went into that income statement and you used the preferred procedure, and that's what finally brought you down to earnings per share, and earnings per share brought you down to the possibility of some growth values then. So I'm seeing how this is all tying together historically, and again, the proof is a pretty easy to calculate by yourself using a value line sheet. And again, our audience, Mark, is telling you that the sooner you can get that onto a dashboard, the happier they're going to be. We're getting a good question from George out in the audience right here. And George wants to know, is deferred tax part of total liabilities?
I don't know. I would be surprised if it wasn't. That's something we can dig into. I do not know the answer to that. I would think that we need an accountant.
Okay,
I'm not even an accountant in my television
and
appearances.
And George, if we haven't answered in the next couple of weeks, be persistent. Ask that question again a couple of times. One of us will eventually be primed to come up with the answer, but neither one of us have an answer for you right now, at least.
I can certainly envision how it needs to be there. And we had a discussion just last week about a company being bought for the value of its deferred taxes, so it's there. So again, analysis completed without the PEs, and PEs drive some of us crazy. Thought we'd take a quick look at Super Microcomputer. I had no idea that this one has been so volatile here lately. Current price of
I,
seven.
and I think that's an understatement, by the way, Mark. Okay,
Well,
if you watch a price chart,
oh, it's yeah, we're going to see a price chart. It's pretty much been all over the roadmap here lately, and it's also volatile here. You're talking about a company who is basically a contract manufacturer for NVIDIA, and among many of the things that they do, but they were basically retained, and they're more. I would actually compare them more to like a general contractor that puts this stuff together. That's this increase that you see right here in business, which has uh, deflected to the upside, and these guys are living pretty large right now. So they've been a red hot stock. I think they were up 300% over a 4 month period when people figured out that this was going on. You can see that the earnings have responded favorably down here. So again, we want to take a look at, well, what in the current situation is the situation with respect to the return forecast, 9%, and the projected return on value of about 6. So let's just kind of walk through the calculation real quickly. Okay, here's Super Micro. I'm going to just go through the points. You only need a handful of points, as Ken just said. You want to grab a fairly current sales forecast. In this case, if you add up, as we often do, the last four actuals, you're going to get this number. I would point out, again, as you're thinking through the analysis of this company, that we're actually past this point here, and that you probably could use those four numbers, and that this number is rightfully a little bit higher. Uh, so actually above 10,000, approaching 12 million right now, and 12 billion, I should say. And you can see that that is also shown here. It's inflecting to the upside. So this number is a little bit low, so it's conservative. All right. The sales growth forecast, pick your number. Ken, are you okay with 27 or?
well, I'm okay. But Mark, I want to go back to the sales number. If I'm not pleased with proof uh, comparing to par when I'm using it, and when I see a quarterly sales box like I'm looking at in Super Micro, and I'm looking at the last two estimated quarters in 24 versus the last two real quarter numbers in 23, I'm saying to myself, that's a significant difference. And I probably would do two proof calculations. One of them with the trailing four quarters, like you're doing right now with the 92.53.
Mm-hmm.
But I also think that I would do a proof calculation using 14.5. That's the full fiscal year with two real numbers and two estimated numbers. And I think I'd want to see what those value line estimates give me an approved number as I'm beginning to try to compare it then to what my par number is going to be. Right now, with par 50% higher than prove, boy, I hope people are following my arithmetic. With par 50% higher than prove, I'm a little bit concerned that that's a pretty wide variance. But I think if I'm using a different sales number, that variance might close itself pretty quickly.
Oh, it would. It just using
I know it would.
the most recent quarter would tighten it right up. And again, I look at it a
Yeah,
little bit differently. I just compare the difference between the two numbers, not necessarily the percentage. And I
yeah.
basically use a plus or minus 5%.
Yeah, and that's a place that you and I look at these slightly differently.
Hmm.
I like to know what percentage above the proof number is the par, and when it approaches more than half, more than 50, I become a little bit concerned about it then.
So would I use 20%, 27% for this company going forward? For now, yeah. I mean, that's the red dotted line that you see there, but I would probably be looking for any excuse to drop back a little bit, and just monitor it very closely. That can't stay there for a tremendously extended period. So we all know that from all of our studies. So what you need to do is calculate, what is the calculated value 5 years out, because we need that for our calculation. So take the 92.53 and basically bump it up by 5 years at 27%. That's the calculation. 92.53 times 1.27, that's the 27%, to the fifth power gives you a $30 billion company. That's this point. Basically a $30 billion company 5 years from now. And you can see 14 and 20, and you can get there with some gymnastics to 5 years out in 2029, where 30 is feasible. Okay, we need the operating income at that point, and that finishes our numerator. The operating income again. This is the period where they have been again that general contractor for NVIDIA and others, but they are really making more money than they ever have on it from an operating margin perspective. You can see those recent years and the projected year. So somewhere in that 9 to 10 range makes a whole lot of sense to me. I went ahead and used 10%. So this 5-year forecast for top line sales times a 10% operating margin, I just took the 10, gives you about 3 billion in operating income 5 years from now.
I think it's useful to say, Mark, that just like on an SSG, when you're doing a lot of your judgments, there is a range of reasonableness that you can expect. And we've been pointing out that there are probably other reasonable numbers we can use in this calculation. I don't think I'd fault you if you were to use 9.5 instead of 10, or if you were even to use 9 instead of 10 in that operating income number. I think they're both reasonable. And that's the key, I think, to the whole exercise, whether you're doing a proof number or whether you're ending up with a par number, either one.
Absolutely. So let's go ahead. Now that we've got the numerator, let's talk about the denominator. The denominator is 3 numbers. The first one you can just pull from value line, for example, that's 60 billion market cap, or I prefer to calculate it. And this is what I was talking about volatile, Ken. This is only 7 days difference. They were over $1,000. You see that on the next slide, but they dropped down to 700 times 63 million outstanding shares. So we're talking about a market cap of 45 billion a week later.
And I understand, because I've been watching the price of this stock over the last couple of months, and it has had just insane swings in both directions.
So obviously, if you're doing your own calculation here, the difference between using 60 and using 45 should be obvious after you crunch through a couple of these. Now, for total liabilities and cash on hand, you can simply go to Morningstar, grab these 2 numbers: the total liabilities, most recent total liabilities, and most recent cash and cash equivalents. Might be interesting to see if that one includes those deferred taxes.
Well, while you've
Question
been
for another day.
talking, George went to a company that he knows something about, and
Okay.
he's discovered that, in fact, it seems that that deferred taxes are included in total liabilities.
Okay.
So he's answered his own question, at least for a specific example. So we have a little bit of information about that.
Makes sense. I mean, it's basically a form of value, a form of currency, if you want to think of it that way. So anyhow, here's our 3 points: the market cap, the total liabilities, and minus the cash on hand. You take these 3 numbers and you come up with this calculation. So the enterprise value, using this stock price, gives us that 6.5. When you take the numerator of 3057 at 3 billion, this number right here, and divide it by the enterprise value, you get, again, 6 or 7% for the projected return on value. Okay.
Mark, we're getting a question from Daryl out in the audience, and he says, "Okay, well, now how do you use it?" And Daryl, it serves as a redundant value, which can help each value validate the other. When par comes close to prove, then we're validating par. When prove comes close to par, then we're validating it the other direction. And when they're close to each other, you're getting a feeling that your analysis is on the right track. Nothing will guarantee you that the analysis is spot on. There is no guarantee in doing this kind of forecasting. But when those two numbers end up being close to each other, you're getting some validation using two completely different methods that you probably are on the right track. That's what it's used for.
Yeah, and in this case, what you're looking at on the left-hand side is a traditional preferred procedure. Basically, it's a modified preferred procedure if you want to think of it that way, but you come up with a projected annual return of approximately 9%. And that's based on that 27% growth, a net margin of 7.5, and the killer number, the PE, down here at the bottom. So those three numbers are basically what give you, in combination with the current price, this return forecast. So we compare that over here to one that is, I say, 3 percentage points lower. And if I'm doing my study, I probably have thoughts about reducing this down. If I'm actually making a presentation to my club partners, I might throw 28 in there. Based on looking at the charts and everything else, I'm going to be wrestling with this notion of a PE of 32 and put in 28 instead. And I suspect that 28 would probably take it down to where it would compare very favorably to this 6.3. So
I would
go ahead, Ken.
I would further make the case, Mark, that if I were presenting this to my club, I would like to really not play around too much with what I've already done or what you've already done here. But I would like to say that the extreme volatility in the stock price of Super Microcomputer in the last 2 months, maybe give them some examples, maybe show them a simple price chart. I think that contributes to the fact that these two numbers have a little bit wider variance than we'd like.
There's your price chart. I mean,
yeah.
that 60 billion market cap is from the top of that red bar. Actually, the bar before it. So again, that's just a few days, and it's done that. And it's
So
actually
from March into March to now, we've gone from 1,200 about down to 7.25, right? Or below 7.25, it looks like.
right. And what this is telling us is that what would that be? 512. So it would be almost 50%, 42% drop in price, and it's still not the deal of a lifetime, according to these numbers, after a 42% price drop. And with very ambitious expectations that something like this is going to happen.
Yeah. Maybe the market fell in love with this stock just a little bit too early, huh? What do you think, Mark?
Well, that's a run from 300 here at the beginning of the year to 1,200 here. That's a lot.
Yeah, is it?
and we met a phenomenal investment club that Ken and I are going to do a little more homework on. That they basically bought NVIDIA and wrote a very similar pattern up with them. So yeah, congratulations if you're out there and you've enjoyed something similar to this. Ken, why did I not bring Super Microcomputer to the December roundtable?
Mark, I don't know. Okay, I don't. Sometimes it's
They
just, it just skips and leaves. Skips right over the top of our heads, and we don't even look and see that it's happening.
Well,
So.
I remember specifically thinking, what in the world are these people smoking back in the time frame? All right, pressing on. Moving on to Buttonwood. Hopefully that helps you understand our emphasis on proof and why we care about it so much. By the way, we find, as you saw in that previous slide, they line up when you look at the large sample of companies, and this is, again, 2,700 companies. They are on track with each other. So variances are something that we pay attention to.
Mark, I don't know if Daryl out in the audience is using the Socratic method to lead the discussion or whether he has a genuine question. But Daryl, your question about how might we use prove rather than par on a young company, and I think the answer is fairly simple. A young company might not have earnings, and therefore, with no earnings, it might not have a PE. It will have the values that we use to calculate proof. So
Yep.
becomes something that is a no-brainer. When you can't calculate a par because you don't have earnings, you might want to calculate a prove, at least to give you some idea of what return might be going forward. Now, there's a lot of hope built into that when you're trying to project things for a company that hasn't yet proven itself, but it might at least give you an idea of where they're going.
Yeah, and to make the point, it's not always not having any earnings. You could be in a situation where the company you're studying now has 10 cents. So it still doesn't have a PE ratio, not really. And all of these numbers from there on down get kind of crazy. But over here, and that's one of the reasons that we lean on it for early stage companies. Those will stabilize earlier and give you an opportunity to evaluate the investment. Again, just like it says on this slide, um, basically looking at uh, any business, being able to do this, evaluate anything, and early stage comes in also here. So Daryl, you're right. All right, so let's go ahead and press on, Ken. Here's Buttonwood. I don't know if we'll make any decisions today. Um, I do like to point out that one of those awesome stock studies I did last week, Vertra, is holding its own up at the top of the list. One of our micro companies, but pretty good from top to bottom. The thing that we do want to focus on this week and probably next is this slice of the pie here. We do want more technology.
Agreed. Absolutely
So
agreed. Uh-huh.
here is a look at the top 20 technology stocks ranked by Manifest Rank, I think. Um, we'll look at it in a couple of different ways, but there are some interesting companies here.
And we should put a check next to EXLS because, in fact, it is in the Buttonwood portfolio.
It
So
already
we
is.
already have one of these companies in the portfolio. Yeah.
And I don't know if you held a gun to me right now, Ken, not at my head, but maybe at my foot. Um, I really like the way that this NICE shapes up, and maybe we talk about that in conjunction with our work on the consulting industry next week. And I'm actually a little intrigued by Susie Artsberger's presentation on Double Verify. I am looking at this annualized return and this growth rate as being pretty attractive. Um, RSI is good. By the way, this can be used as an example. Many of these down here, I would probably just set them aside as potentially cyclical. Um, Maybe just set them aside and basically ignore them a little bit. This one's not easy to ignore, but at least until I see some more information. So, and what's this one up here? Ubiquity Networks. I don't know much about them either. But
I'm intrigued that one of our former favorites is on this list, down there in the second to the last place, Mesa Labs.
I do like
That's
that one.
kind of intriguing to me that it's on this list. It was a community favorite, a half dozen, maybe less than that, years ago. The other one that I think deserves some thought, Mark, even though it sits in a place in the world that might be a real problem, is this Taiwan Semi. We don't have it in too many portfolios, and yet it just seems to consistently perform at a level that maybe we should be considering owning a little bit of it.
It's an incredibly profitable company, and they are in business with NVIDIA, um, and they have
And
not
with
gone
almost
crazy.
every other chip maker in the world. Yeah,
Yeah, they make a lot of stuff, and
yeah.
so yeah, that would be a good one too, and it
And
qualifies for
and
profitable.
soon, soon in building time, so maybe the next 3 or 4 years, they'll be manufacturing in this country as well.
hmm hmm So it's a decent list. I think we want to, double down on our efforts to shop amongst these companies and make some decisions. Um, we did turn back to our microcap listings from last week. Here's a couple just to think about. I have a dentist appointment day after tomorrow, so this is first in my. Yeah, I don't even like to think about that device on the right, but that's what these guys make. They're out of Irvine, California. You're looking at some price screen captures from Y charts. You can see that the price has kind of sagged back a little bit. Those are 10-year charts, but the revenue chart is compelling. And yes, Ken, here's a small company with revenues and earnings for the 10-year period.
I'm uh, I think you're going to show the next slide that shows some graphs, and while I love the fact that it has earnings, I'm not especially enthusiastic about the way that earnings line looks. So
Yeah, I'm a little concerned about this one. I would want to maybe give it a little bit of runtime and hope that we see a little bit of this type of action with that last one. And this is also a little bit unsettling here too,
yeah.
from in the
Uh,
grand scheme.
I will tell you, Mark, that I am diligently working through this list along with the appendices that you posted at the last uh, roundtable or last bull session, and I'm having a difficult time coming up with candidates that I really feel confident about. So I think they're very interesting, and this one here and this one. They're very interesting companies, but I keep going back to my standard disclaimer at the beginning of talking about small companies 30 years ago, when I
Hmm.
decided that I should be able to find small companies that are behaving in their visual analysis very similar to the large companies that I own or to the medium-sized companies that I own.
Well, this one's
And
pretty good. I mean, this one came to our ladies of the forum, either Marie or Sandy or one of them actually brought this one. This is actually a desalination. Did I say that right? Desalinization company.
well,
Go ahead.
you taught me with a home builder's graph, and you drilled it into me that it's a good idea to look at what the analysts are saying out into the future. And I don't like where the analysts are coming from out into the future for earnings. I do like the 21, 22, 23 earnings line, but then the
Well,
analysts become kind of blasé about the company right there. So,
yeah, and if you dig in a little bit closer, though, you'll find that the 2023 included a lump sum payment on a project in Arizona, and that's the bump up that you see here. So
okay, that
it
that does change. That does change the calculus in what I'm thinking. If that dot in the earnings moves down and then that becomes a relatively smooth upward trending line, that looks much better to me than it did just 26 seconds ago. So,
yeah. So the more you know. I mean, I do think this company could be very interesting. I do wish that the growth rate was a little stronger. It might be interesting to study. Do they have any other Arizona opportunities, in the pipeline? They actually operate out of the Cayman Islands. They have a couple of plants in the Caymans, but they also have, I believe, a project in Indonesia, the Arizona mentioned project, and a couple others. But uh, this is an important topic longer term when you think about the supply of fresh water worldwide. And if these guys have a decent mousetrap and experience operating these facilities,
Mark, Sandy Castor just wrote one word to me right now, and she wrote Hawaii.
Hawaii, that's
Do
right.
they have anything to do with Hawaii?
I do remember seeing that now. So thanks, Sandy.
Okay.
Yep,
And we're getting from Janet out in the audience the NSSC. Isn't that the top performer on our best small companies list right now?
it is.
Yes. So Janet, we've actually discovered that particular company, and we actually put it on our best small companies list. And boy, is it performing for us right now. To the detriment of the rest of the list, but it's really, really doing well. It has this year. I have not looked at it in the last week, however, so I hope what I said about doing well is still okay.
So Ken, I think I would send you away with the assignment of double checking me, fact checking me on this Arizona project, and then maybe we consider this one, give it a little more due consideration.
Okay, so you want a slightly deeper dive on CWCO then, right?
I think so.
All right. Well, let's see what I can do in the next. Oh God, it's busy the next couple of weeks, Mark.
I
It
know.
might be a week and a half before it ends up
Well,
being done. Oh,
we can live with that. We've got a few more
all
companies
right.
to add here, and then we'll continue our talks on Pepsi and a couple others. So,
Okay.
all right. So with that, just a reminder that we do archive all these sessions, including the bull sessions and roundtables. And you can see there's a four-part series here that we recently did, aimed more at novices and beginning investors, but I count all of us in that realm, frankly, because I learn something new every day. Um, and then foreshadowing, we are going to talk about. Go ahead, Ken. Did you have another question?
We no, I just wanted to announce our roundtable coming up on the 30th of April, a week from today. If you would like to get a registration link, fill that form out, and we'll try to help a little bit since it's very close to the April date. Also, if you drop me an email, I'll see that you get a link sent directly to you. For the roundtable if you're not on our guest list already.
All right. So this is just a little foreshadowing. We are going to continue to tackle this subject. Here is the subject. Since the pandemic, we want to take a look at moats and growth patterns since the pandemic. And McKinsey is just an indicator or a tip of the iceberg. Here is a look at some of the stuff that we will be looking at in a couple weeks. This happens to be the combination of screening results on the information technology consultants and sprinkling in some of the software application stuff because they tend to run together. And it's an interesting list of companies. I think we know most of them on there, but Ken has his eye on Genpact. Keep in mind that XLS is already in the portfolio. So we don't want to go too crazy. Of course, if we showed this list to Cy, he'd pick 6 of them to put in the portfolio. So
I
stay
don't
tuned.
see EPAM on here, Mark.
EPAM did not make the quality list,
Okay,
quality
so
sort,
we're basically sorting it by
the
quality,
quality.
and we're just trying to reduce the large number of companies that are in this uh, kind of amalgamated industry, kind of a combination of two different industries from Manifest, and trying to come up with a list. Mark, the last time that we saw such a concentration of fairly decent companies in a single industry, that didn't end real well. Am I correct in reminding you about that?
Yeah, but
Uh,
this one is,
yeah,
I mean, this one's different. I mean,
okay.
there's a lot of business out there in this realm worldwide. The Accenture stuff. Um, it's an
Well,
area that I'm pretty familiar with, and
I do like the fact, Mark, that the scope of the business is much wider than the last time. And the last time that we saw this happening was in the education for profit industry, and uh, everybody was touting everything in that industry, and the PARs were all of them coming out, and we felt that they couldn't all survive, and in fact, most of them did not survive. But this has a much wider base of business, and there's much more nuance to the various kinds of things that they do that get them included in this industry. Tomorrow night, my club, the Mid-Michigan Model Club, is challenging Cognizant in our particular portfolio. And I'm going to do a ticker talk along with Ann Cuniaz tomorrow night, and Ken Zach, who's going to be with us also. And I'm going to show how you might come up with a suitable group of peers that you can use to challenge a company that you might already have some skin in. My club wants to challenge Cognizant. They'd love to stay in this industry, and they're wondering, when they bought Cognizant, they felt it was the best one in the industry, and now we're not so sure. Is it still the best one in the industry? So we're going to kind of put it up against 4 or 5 of its peers, and to do that, you have to be able to identify them. And I'm going to show how you might do that using some of the tools that are available to Better Investing members.
Yeah, one of the most popular features we've ever done dealt with specifically with Cognizant a couple of years ago. And we pointed out a change in management at the top and some of the challenges that they face. I think what we will discover as we go through this study is that, yeah, there's going to be a lot of winners here, but Cognizant has not exactly kept up for whatever reason in recent years. So it's a question for not only many of us in our personal portfolios, but also the roundtable, which is full of these type of companies. All right, end of the foreshadowing. I don't even have words for the picture on the left, Ken. Um, Apparently that's coming, and there will be no such thing as a closing price anymore, or something like that. Um, I'll just leave it go for now.
How I'm just going to pose a single question, Mark. We have all of these mutual funds and exchange traded funds. For an ETF, it's not so important that they give you a price that you can cash out at. If they're going to trade constantly, they trade like a stock, and that will work. But how will you calculate? There's still going to have to be some moment when a mutual fund can value itself so that it can redeem its shares.
Yeah,
So
I
we're
think
still going to need some kind of a closing price at some point,
they're going.
whether it's just arbitrarily set at a time or what, I don't know.
I believe they will probably settle on 8 p.m. Eastern time as that moment in time.
Okay.
That's just my instinct based on other stuff. And then of course our kindred spirits, the Blues Brothers, 46 years ago today, made their first appearance.
Those are not younger pictures of Mark and me. Okay.
Oh, it could be. I think I have stood right where they're at. That's near the
That's
Mobile Refinery south of Joliet, Illinois. And,
that's Dan Aykroyd and John Belushi. That's not Mark Robertson and Ken Cavula. Okay.
all right. All right, just a couple of filler slides here in case you have more questions about manifest investing, but also at the back end as the appendix are the companies that we found when we went looking for companies that had a little bit of market cap size and positive earnings. So these are profitable companies, and they're sorted by descending growth rate. So you can sift through them. You can see that here's Consolidated Water right down here in the middle. Um, I've been searching and have not been coming up with a whole lot of them, but Sandy and others have been sending them along. So please continue to do so. If you find one of these that will just warm the cockles of Ken's up straight and parallel heart, that's what we want to see.
I will say, Mark, that the top one on this last list, I was very surprised to see Medifast up there
I was too.
because it has been something that has even been chosen at some of our stock panels as
Hmm.
a possibility to take a look at. So you might want to take a decent look at Medifast and see what's happened to it recently.
Well,
I don't know. I haven't looked at it yet. I haven't got that far down the list yet, but
I can tell you that
it's
that is in
interesting.
a basket of companies that have been deeply, whether they deserve it or not, been impacted by the GLP-1 efforts at Lilly and Novo Nordisk. That's part of it because they make stuff along
I'll,
those lines.
I'll leave you with a tidbit that Natalie and I read in one of our magazines, Mark, and that's we have an article on the research being done in the GLP-1 uh, uh, medication for Parkinson's disease, believe it or not. So it's very promising research that's being done for Parkinson's disease using these drugs.
Yeah, it's the tip of an iceberg apparently with
Yep.
the work being done, and I'm well aware of Eli Lilly's efforts in Alzheimer's and all kinds of other stuff too that's related.
Well, well, Parkinson's would be a huge market if, in fact, the drugs prove effective in doing anything to either deal with the symptoms or deal with the disease itself. So
All right. So with that, if you spot any exciting smaller companies, we are now turning this into around the. Usually we only talk about it in the months preceding Halloween, but the sluggishness in that entire area of investing potential, these smaller companies, continues to percolate, in our opinion. So we will continue hunting them down and trying to prosper from them. So with that,
I,
anything
I
else, Ken?
I I just found myself yesterday, Mark, talking to Natalie about some of the small companies in her IRA and in my IRA, and almost together the two of us said buying opportunity. So we're not running from them. We're looking at the high quality ones, and we're doubling down on a couple of them. So
And look at it this way: if it doesn't work out, we all go down together.
you got it.
All right.
Good
All right.
afternoon,
All
everybody.
right.
Good being
Thanks,
with
Ken.
you.
Take care.